The stock market for beginners. It's all about understanding the basics of investing so you can really harness its power. The stock market can be mysterious and it's a massive challenge for beginners to understand. You'll probably seen various segments on TV and overheard certain conversations from certain individuals that quite frankly make zero sense. It's like they're speaking a whole other language. However, every person who has a good bit of money seems to be using these sorts of methods and using the stock market. So you're curious, are you missing out? Well, today I'm going to break down all the jargon that you hear and translate it into really simple terms so you can progress to the beginner's phase as soon as possible. A lack of understanding keeps a lot of people out of the stock market, which is a massive shame. So in this video, I'm actually going to show you how you can turn £6 a day into 1.1 million in a time period which is actually far quicker than you would have thought. But don't get disheartened though if you haven't started already. It's never too late to get started, and also you've actually probably invested already without even knowing it. If you have any form of a pension, either one through work or actually a state pension, then you're actually already investing your money in companies, but somebody else is doing it on your behalf. So let's start by explaining what people mean by the stock market. So the stock market is what it says in the tin really. It's a market where buyers and sellers meet to exchange stocks for money. Stocks, which are also referred to as shares, are simply a piece of a company. Imagine cutting a pie into 10 pieces. Each slice would represent a stock or a share of a company. It's that simple. So buyers are looking to buy these slices of companies, and sellers are actually bringing along their slices and are willing to sell them for a certain price. A stock or share price is simply the going price for that part of the business. If your pie is worth £10 and you split that pie into 10 pieces, then its share price will be £1. But if you split the same pie into 1,000 pieces, then each share will be worth just 1 penny. This shows you that a company's share price doesn't tell you how much the company's worth, as you need to know how many shares are out there. The share price is decided by the buyers and sellers through simply supply versus demand, meaning how many people are looking to sell their stocks and how much demand is out there for people to want to buy that stock. Where buyers and sellers agree to meet in the middle and exchange, that forms the price of the share or stock. If more people want to sell their stock than buy, then the price will go down. If more people want to buy than sell, then the price will go up. Okay, so you know what a stock market is and how stocks and shares of companies work, but what's a stock exchange? A stock exchange is a geographically based stock market. You might have heard terms such as Nasdaq, Wall Street, or London Stock Exchange, and they are all examples of stock exchanges. The Nasdaq is a shortened term for the Nasdaq Stock Exchange, which is based in New York. But then also in New York, you've got Wall Street, which is the nickname for the New York Stock Exchange, as it's situated on the road called Wall Street. Lastly, we have the London Stock Exchange, which tells you everything you really need to know. Companies can choose to list on more than one stock exchange, but that is extremely rare. Examples of companies which are found on these stock exchanges could be Apple, which decides to list their company on the Nasdaq, Coca-Cola lists themselves on the New York Stock Exchange or Wall Street, and Unilever is listed on the London Stock Exchange. There are many other stock exchanges around the world, including places like Japan, France and China. Next, let's look at one of the best things about owning stock of a company: dividends. There's a good chance you've heard someone talk about dividends before. Dividends are probably one of the truest forms of completely passive income. The only requirement to receive a dividend is just simply owning the stock of the company or a share of the company. Dividends are the part of the company's profits that you get, as at the end of the day, you're an owner of that company. Not all companies decide to give dividends for various reasons, which I won't go into in this video, but payments can be around about 1 to 3% of your share price each year, but that really depends on what company you buy. So let's say you have £100 worth of a company stock and they pay a 6% dividend a year, then you'll get around £6 a year as a share of the company's profits. And what do you have to do that? You just need to own the stock. It means your money is working hard no matter if you're working, cleaning your house or sleeping. There's also another powerful component of the stock market that you've probably heard about and you really could do with knowing about. It's called compounding, or compounding interest maybe. This is what is going to turn your £6 a day into 1.1 million. Compounding refers to when you reinvest growth for even more growth. A quick illustration of compounding can be demonstrated on a chessboard. If you start on the first square of a chessboard with a single grain of rice and you double the amount of rice from one tile to another, how many grains of rice do you think there'll be on the chessboard by the end of it? Have a quick guesstimate. 50? 1,000? 1,000,000? there'd actually be over 18 quadrillion. That's 18 zeros. This is based on getting 100% of return every year, which is extremely high within the stock market, and you won't see it very often, if at all. So let's make it far more reasonable and keep the chessboard concept. Let's imagine for each square is a year of your life, and let's pick a reasonable growth level. Let's put £1,000 in the first square, and let's imagine we can grow that 10% each year, or in our case, each square. We don't add any further money at any point or take any out, we just leave it. How much money would you have after 64 years? Just over 556,000. That's how powerful compound interest is. Another powerful concept that you need to be aware of is an ISA, and in this context, a stocks and shares ISA. I have a whole video about it, which I'll put up here if you want to watch it at a later date. But in a nutshell, it's where the government allows you to invest up to £20,000 per year within your ISA. The £20,000 is normally referred to as your ISA allowance. But what benefit is this to you? Well, any money that you invest within this stocks and shares ISA is protected from the taxman, meaning you don't have to worry about paying tax on any of the money that you make within this ISA, either from the shares increasing in value or the dividends you might get paid. Every penny counts, especially when we're looking at taking advantage of compound interest, so please make sure you're utilising your ISA allowance as much as possible when you're investing. But when it comes to stocks and shares of companies, you don't have to buy single stocks of companies, and if anything, that's more risky. A solution to this could be that you'll buy an exchange traded fund, which is commonly abbreviated to ETF. An exchange traded fund is basically buying a portfolio of companies in one go. I personally buy an exchange traded fund. My ETF costs me around £80 a share at the moment, but that £80 is split across 3,800 different companies all at once. Imagine if you had to personally buy 3,800 individual stocks of companies. It would take you weeks, if not months, to do. But why would you choose to do this? Well, in a nutshell, it helps reduce volatility. Some companies are going to do well, actually some companies might do poorly. But it means your downside's protected, as it's extremely unlikely that all these companies are all going to go bust at the same time. But then you've got to think, it's very unlikely that all these companies are going to double all at once as well. So your upside and downside is pretty limited. It's obviously a lot more likely if you hold stock in just one company. I've heard of an ETF, but what's an index then? Well, they're quite similar, but the best metaphor I have for you is that an index is the ingredients for a cake, and the ETF is the cake. So you could buy all the ingredients yourself, being the index, and then you could make a cake out of that, which is an ETF, or you can be lazy and simply just buy the ETF straight away, or just buy the cake from the shop. But what about passive versus managed funds? Well, passive funds are ones where there is actually very little buying and selling a stock within the index. It's more about going with the flow of the market rather than actually trying to beat it and play it like a game. The fees for managed funds are typically very low. For my personal ETF, which is a passive fund, I'm only charged 0.22% per year, where a managed fund is actually managed by an expert. So they manage your money to try and beat the stock market and avoid picking bad stocks, I guess. The only downside here is that they actually charge a very, very high fee. There's actually a lot of research that shows that they're not actually that very good at it. You also might have heard about odd animals from time to time being mentioned, normally bulls and bears. But what do they have to do with anything? This derives from the terms being used such as being bullish, which means that you're optimistic about the future, which is normally associated with stock prices going up. A long-term increase in stock prices is normally known as a bull market. But on the other hand, being bearish is being pessimistic about the future and is associated with stock prices going down. If the decline is over a longer period of time, people might refer to it as a bear market. If you want to get an idea of how much you could potentially make from the stock market, then let's look at some simple sums. If you want to do this yourself, then feel free to search online for a compound interest calculator. You can input the numbers yourselves to make it more relevant to your situation. Let's say you invested £6 a day into the stock market for the next 40 years. If we go through the sums, it will show you that with an average growth, you'll end up with 1.1 million. It's quite incredible, as nothing about this is that unrealistic. It's just £6 a day. But again, have a play around with the numbers yourself and see what the number comes out as. It's actually a lot easier to have more money than you've ever dreamed of, but you just need to persist for the long term. The stock market will swing up and down, and it's important not to sell at the bottom, but then also not being worried to buy at the top. It's all about being consistent and not getting too worried. For this reason, it's important you only invest money which you don't need in the short term, because it'll defeat the purpose if you're just going to withdraw it in a few years' time. Being a beginner comes with a lot of nerves, so that's why it's important to start small so you understand the process. I need to be clear, I am not a financial advisor, so if you want advice tailored to your certain situation, then please speak to an independent professional advisor who's qualified to give you this information. On this channel, I work really hard on being as transparent as possible of what I'm investing into and the reasons why. But your reasons will be personal to you, and your investments should reflect that, not somebody else's. Beginners and even intermediate investors really do sweat over the small differences between one ETF and another, and this stock and that stock. But actually, the biggest difference between people's performance is normally how long they've been invested in the market. So that's why it's really important you get started as early as possible. If we go back to the compound interest calculator, if we look into the detail, we can see in the last year you would have made £86,000 in that final year. So if you delay your start right now for one additional year and it can only invest for 39 years, then the next year of waiting could actually cost you £86,000. It's food for thought. The last piece of jargon we need to simplify is dollar cost averaging. But what does this mean? It simply means putting the same amount of money into the stock market over a regular period of time. This could be £10 a week or £50 a month. The beauty of dollar cost averaging is when the stock market dips, you actually buy more shares for your money. But when share prices are high, the same amount of money won't buy as many shares. On top of this, you don't need to worry about the share price, as buying when it's high and buying when it's low is part of the plan. Holding stocks has a high return, but over a long period of time. We should all remember the 2008 stock crash, but if you kept calm enough through that period, then it would have paid off massively. Well, the good news is that it's never been easy to invest in the stock market. If you want to pick individual stocks or companies, then there's loads of platforms you can get on your phone. You can go with eToro, Freetrade or Stake. I do have some affiliate links in the description below if you want to go and check those guys out. But to be transparent, my main platform I use is Vanguard. There's no affiliate there, I just use them and I think they're really great. They're really famous for having really low fees and a good choice of investments, so that would be my recommendation, but feel free to do your own research. Remember though, your money is at risk when you invest in stocks and shares, but if there wasn't any risk, then there won't be any reward. One of the most popular steps for beginners, especially if you're at a young age, is purchasing a really well diversified, low cost exchange traded fund. These are commonly found on Vanguard, which I personally use, and you're looking for funds that have a no higher cost than 0.3% a year. And you should only be looking to invest if you're in it for the long term. It's too risky to invest over just a 5-year period in stocks and shares. Hopefully this has started to demystify the stock market. It's really not that complicated, so don't be fearful of it, because actually you're probably already investing in it already through your pensions. If you've made it this far into the video, then a massive thank you from me. If you want to learn more about finance, investing or income growth, then feel free to have a look around my channel. I've got loads of videos on there that you might find useful. I do videos on updating what I'm personally investing in and how that's getting on in the stock market. Then I do other fun things, such as actually showing that stock picking is a little bit pointless by getting my dog to pick stocks and seeing how he does. I don't know, it's a bit of fun. Anyway, that's all for this video. See you in the next one.